To cut or not to cut? That continues to be one of the most common questions in Canada this year. And ultimately, arguments on both sides of this decision are becoming more and more valid and more compelling. Now, which side are you on? A cut would be good, a cut would be bad, or maybe just leave things as they are. Realistically, we want to know, how much would a rate cut affect your decision to buy or sell a home? You likely have a lot of thoughts and a lot of questions, and we'd love to help. Schedule a consultation with us using that link below, and we'll connect and share our expertise and advice regarding your specific scenario. Now let's get into today's episode, all about rate cuts. Because despite growing data displaying how weak Canada's economy continues to get, the elusive rate cut continues to get pushed further and further away. Canada's GDP rose a paltry 0.2% in February, almost half or exactly half, and well below the estimated 0.4%. Early data in March points to a flat month as well, putting Q1 on track for 0.6% growth. And now, if that proves to be accurate, it will mean the sixth consecutive quarterly decline and an annual 2% contraction in per capita GDP. So why no cut in this environment, as historically, this would absolutely prompt the BOC to make such a decision? Well, the thing is, over the same time period that Canada has been contracting, the US has been expanding. Ouch, we've completely diverged from one another. Consumer confidence is on the decline again, back to those global financial crisis and COVID lows. This is all accentuated as well at the Bloomberg Nanos poll on personal finances, which fell to a 16-year low this week. That means that people are basically feeling that their personal financial situation is worse today than how they felt back at the COVID depths and the global financial crisis. That is low. This lack of confidence leads to less spending, which leads to a worsening economy, and that will just continue to rinse and repeat in the current landscape. Now, you'd think that the real estate market would be doomed too, right? Well, a lot of the data says otherwise, surprisingly. The Real Estate Outlook Index is at the highest rate since the rate hike started 2 years ago. So now you got to ask yourself, how is this possible when people feel so bad about their financial situation that there's still confidence within the real estate market? Well, one element to this is that home sales per capita have been so low for so long that home sales will likely bounce back even as the economy softens. And almost certainly, based on that recent Bank of Montreal poll that showed 70% of pre-approved buyers are waiting on a rate cut to make a move, meaning there's a lot of people still on the sidelines that if they are enacted, they could easily shift that marketplace and push prices north. We know that certain provinces and certain suburbs and certain areas are hurting. You know, there's areas in in Ontario that maybe have seen a 30% decline off of the peak. But check out this list of provinces that are currently at all-time highs when it comes to real estate prices. Alberta, Saskatchewan, Quebec, with definitely Montreal being at an all-time high, New Brunswick, Nova Scotia, and Newfoundland and Labrador. So you currently have 60% of the provinces in Canada experiencing all-time highs in real estate prices. Not stable, all-time highs, okay? That will definitely contribute to real estate sentiment being high, at least in those provinces. And at these all-time high prices, will not entice the Bank of Canada to want to cut anytime either.
All right, well, let's have a look at insolvencies here, specifically business insolvencies, because there's plenty of data that would lead us to believe, when we take a look at this perspective, that the BOC will cut rates and cut them soon. There's 4 industries that are at 10-year highs for insolvency. When we look at the construction sector, there are 250 companies in the last quarter that are insolvent. The average is around 150. When we look at fire, that's the finance, industry, and real estate sector, it's sitting at 95. Typically, it's at 50. When we look at retail, and this is truly scary, there are 200 companies in the last quarter when the average is 80. When we look at accommodation and food service, is sitting at 360 when the average is about 150. In spite of all of this, the market odds of a rate cut in June are now at 35%. 8 weeks ago, that was sitting at 80%.
So understandably, that type of data would certainly want to pull the Bank of Canada into that, yeah, let's do a cut kind of scenario. But then let's bounce back over again to the real estate and look at some more supportive data that says maybe they are going to get tugged the other way and want to stay where they are. Because we had fresh new mortgage delinquency data out. And as always, it's quite compelling. The percent of arrears to total mortgages in all of Canada, it did increase in February. It went up from 0.18% to 0.19%. That actually beat my expectation. I thought it was going to rise to 0.2%, but it only increased by 0.01%. So 2 years into our rate hiking cycle here and 9 months of 5% rates, and arrears have only increased from that all-time low we saw back in the summer of 2022 at 0.14% to where we are today at 0.19%. And I will remind everyone once again that the pre-pandemic level was 0.25%. So we're still well below that. What's more, the two most expensive housing markets in Canada, being of course Ontario and British Columbia, did not see an increase in the arrears rate. They were stable. They were the same month over month. And they remained the lowest arrears rates of all the provinces at 0.13% and 0.15% respectively. People and our government protect their homes here in this country. Love it or hate it, it's continuing to be the story. And any significant level of foreclosures simply will not be seen here. There's too much equity within homeowners, as we talk time and time again, and there's more proof in the pudding with this arrears data this month. Well, most people will consider this good news. With this metric showing how stable Canadian residential real estate sector is, it doesn't provide the good old Bank of Canada with ammunition to cut.
Yeah, and I think kind of what's more to that too, Dan, is you got to consider a place like Vancouver, one of those highest, most expensive real estate markets, not just in Canada and North America, but globally speaking, and only 50% of homeowners have a mortgage here. So, that's another incredible fact that often gets forgotten about when we're talking about what it will do to the real estate market space. Just if you don't have a mortgage and you're not compelled to sell during this time, then you won't. It's that simple. You'll just wait for a better time. So anyhow, let's touch on US inflation here, because this is a key metric that the Bank of Canada will be looking to, as well as the feds down south, in terms of where they go from here. When we look at the annual rate in the US, it eased to 3.4% in April, down a meager 0.1% from 3.5% in March, which was the highest reading since September. But inflation now has been jumping between 3% and 3.7% for the better part of 12 months. Very sticky, and it's a very difficult last mile in this inflation fight. With that said, there's some things here that will make the BOC, well, especially that, but the cut become less likely. With that said, I do feel there's more data coming right now that is starting to show that the US will be slowing down even more so than what we've currently been seeing. I was looking through a ton of different news articles down in the States over the last week and came across some very interesting data. And check this out. So remember a few years ago when the US touted that Americans had saved $2.1 trillion in their savings and checkings accounts? This was due in part to money being handed out by the government, helicopter money, loans, all that kind of stuff. In fact, it even prompted arguments back at the time that we could introduce a universal basic income. People were going to use this money to pay down their credit cards. They were going to use this money to stay afloat so that it wouldn't be such a burden on the actual system. But let's not forget that down south, Americans, more than anything, are professional consumers. They really know how to consume. More than half of the Americans down south don't have any savings and also have no investments. So you got to think about that too. So if you provide them with $2.1 trillion, instead of investing, it usually gets spent. So much so now that we are seeing, if you go back to March 2024, that $2.1 trillion that was accumulated during the pandemic is now gone. All of it. So if you wonder what's been keeping that US system robust and moving forward when everybody else was feeling pain, it's likely because of this huge amount of savings that they were sitting on, but that they were burning through. Retailers now are getting pretty nervous about it. And if you look at, for example, shares of Tyson Foods, the world's largest meat manufacturer, on Monday, their stock plunged 6%. And their CEO cited consumers are just not spending like they used to. Starbucks also had a massive correction in their stock, and Cuts forecast consumers are dealing with tough macroeconomic environments. McDonald's CEO talked about how consumers' day-to-day spending has been cut because of, again, macroeconomic environments, but at the same time, it's putting a lot of pressure on the entire quick service industry, quick service restaurant industry, not just McDonald's. We've got announcements later this week for Disney, Airbnb, Uber, Anheuser-Busch, and I think we're going to see a lot of the same themes that we're seeing with Starbucks, Tyson Foods, and McDonald's is going to be spread across this entire economy. So if the US Fed continues to hold rates for longer, things could also get a lot worse a lot quicker, especially without a $2.1 trillion cushion. Where do people start to pay for things when they no longer have cash? Well, they start to look at assets and things like that, right? They'll still sell their stocks that they might have bought during that time period. They may even look at selling some houses. What's more, one of the biggest hedges of inflation in the US has been the fact that they have a 30-year fixed rate that's available to all home buyers, something that we can't get here. We typically can get as high as 10 years, but we don't have a 30-year fixed. And when you look at what happened in the pandemic, people were able to get a 30-year fixed rate on a house at 2% or less, 1.8% for the next 30 years. So they were able, that is the greatest hedge against inflation, when you can fix your cost of your greatest asset and watch prices around you rise, especially when one of those things are wages. So if you can cap your spending and you can increase your wages, then you have a more robust economy. And this is what the rest of the world, why they hate the US so much, why their economy is so robust. We deal in 5-year terms here, and we deal much more on the variable side. So I guess the question becomes, with no more savings in place, are we going to continue to see insolvencies and delinquencies rise in the US? Will that then bring rate cuts back on the table for this year, or will they be able to maintain the current pace they're at going forward?
Kind of feels like the US is or has about a 12 to 18 month head start financially on where Canada sits. Mm-hmm. So they're just basically going to bleed us dry in a sense, you know what I mean? Yep. Because they can just outlast Canada. Canada would love to cut now, but they can't, as we talk about often, how they are so tied to the States. And if they cut now, it destroys the dollar and we import inflation at a pretty high rate here.
I think, Dan, too, to kind of that point, and to the point maybe of some of the macroeconomic analysts who've been speaking that there will be divergence this time around from what the US does and from what Canada does. This is a prime example of that reason. We can't go the next leg with the US without lowering rates or without doing something that will help us get there. So much to your point, I agree entirely.
So we will see. Now, part of what might help answer this question and this tug of war for the Bank of Canada of when we may or may not see a rate cut is let's look to history, right? Now, history doesn't always repeat itself, but it does like to rhyme. So let's compare our current rate hiking cycle to the ones that have happened historically. Let's go all the way back to the 1970s, where we've seen essentially 4 similar major rate hiking cycles. When it comes time to when the first hike started to when the first cut started is a really interesting metric to track. So let's go back to 1978 and their rate hiking cycle. When it lasted, first hike in 1978 lasted all the way to 1981. There was 41 months over 3 years between first hike and first cut. Jump forward to 1988 to 1990, that was 28 months between first hike and first cut. Then we look to 1997 all the way to 2001, 42 months. And then lastly, 2005 to 2007, 27 months. In incremental measurements here, we've got 27 months, 28 months, 41 months, and 42 months. Well, where are we at today? 27 months. Okay, so we are within the realm right now of when historically rate cuts have happened within the cycle. Good chance it could start anywhere from next month to maybe another 14 months from now, again, if history repeats itself. So really interesting metric to look back onwards and say that, hey, we're within the potential realm of a cut anywhere, like I said, between now and maybe a year from now.
Yeah, and speaking historically too, well, let's also look at housing starts too. Trudeau had planned to build an additional 2 million homes over the next 7 years. That plan is at least up to a rough start. It was 3.9 million in total, but 2 million additional homes. So housing starts are down almost a full percentage month over month and are down 8% year over year. That's a tough start for a new campaign. This is even worse in BC, where homes are needed the most. Stats are down 10%, both month over month and year over year. With interest rates where they are, no notable relief in the 30% taxation on new builds. And the red tape still results in permits taking at least a year or more to obtain. So don't expect any significant increase in starts for at least the rest of 2024. And Trudeau's proclamation to build more homes will ultimately turn out to be another empty promise. Just like his promise to make homes more affordable back in 2015. The next 7 years, home prices and rent more than doubled, right? Claims of building new homes or proclamations to build new homes are easy to make, but truly understanding the nuances involved in putting those homes to the market is something entirely different altogether. What's more is if we kind of take a little bit of a history lesson and look down south too, because prices in the US, I don't think are likely to fall too much either, even if they enter into a recession. And one of the biggest reasons why is we are not in the same scenario that we were in 2008. There's not a whole bunch of really bad mortgage-backed securities that could crumble the financial system. And the US government has learned its lesson from 2008, much like governments all around the world have. So if you look at this, for example, the US currently has 750,000 active listings across the country. And so for some perspective, a balanced market would be closer to 2 million homes. And for historical reference, in 2008, when things were really bad, there was upwards of 4 million active listings. This is what will crater prices. But active listings are way down in the US. And it's possible that that could continue to go. Especially if the US economy continues to slow. It's not like they're going to start building a whole bunch of new homes. When you look at that and you consider the fact that people are also in their homes at 30-year fixed rates at 2%, even if if the US enters a recession and one of those people loses their jobs, they're going to have unemployment insurance plus the potential of a combined income on the other side that will carry them through that tough point. Renters unfortunately don't have this because rent will continue to drive up. They can't fix that cost. The other thing to pay attention to is that, if things got really bad here, remember in 2008, it took 7 months for governments to bail out the banks. When you fast forward to 2022, when that Silicon Valley Bank sort of episode took place, it took them 3 days to bail out the banks, and that nipped the whole cascading event in the butt. I believe governments have also learned their lesson here. So if both Canada and the US enter a recession right now, and let's say down in the US at least, there's 161 million people that are employed, and if they lose 20 or 30 million jobs, there's still going to be 140 million people employed and nowhere near enough active listings to create a price environment that will crater. While I do think, we're in a bit of a tough position here, and especially up in Canada, where we need more housing than ever, we just don't have an ability to get there in the timeframes that have been pointed out. And to think that, our economy is going to get so bad where prices are going to drop so much that people can enter the market at 30, 40, 50% discounts, that's just not also on the table either. It's more like stagflation. Things are just going to truck along sideways for some time, where people are going to get stretched and unaffordability and the quality of life is going to come down until our GDP and the rest of the economy starts coming back with it.
So I found that stat super interesting and wanted to compare it to Canada. And what I mean by that is total active inventory divided by population. And yes, obviously 1-year-olds aren't buying homes, but let's just work with me on the rough math here. In the States right now, for every single one active listing, there are 444 people that could be interested in it. Okay, that's pretty tight. In Canada, for every active listing, there's 325 people in the population. So it's actually tighter in the States, which could mean the States may see upward pressure in prices outpacing Canada in the next while, which we have not seen for some time, but it sounds like they may be poised for just that.
That's exactly my point, Dan. You nailed it right there. It's
Perfect.
Deceiving because it's hard to tell, especially with all the noise that you're hearing, but you have to look at active inventory versus the amount of people that are trying to buy. And even if you wiped out, Dan, 20 million or 30 million out of that population count, you would still have a position where the US is more poised for growth than Canada.
And of course, they've got the lower price point to start with,
much
too.
Much lower.
So there could definitely be some regions in the States that we see prices rip in the next 6 to 12 months here. But let's get hyper local here again, because we all know that last month, GVRD saw a surge in new listings, and it definitely caught a lot of people's attention. And we mentioned when we did last month's stats that we were going to keep an eye on how things are trending here in May in case, or to keep an eye on if that is going to start to become a trend. Is it happening again? Well, here we are. In April, there were 7,069 new listings. Halfway through May, we are at 3,460. Okay, so it is almost verbatim. It is quite similar, meaning we may very well be onto a trend here. Inventory increased around 1,600 total in April to just under 12,000. Currently, we are at 13,500, an equal increase to all of April, but only halfway through the month. Though always keep in mind, many properties are delisted at the end of the month, so we'll see where that all washes out. Though these new listings are trending at April's pace, so we will very likely see similar inventory increase at or above what we saw last month. So is this going to mean some opportunities for buyers? Well, maybe. As we know, we are seeing 4 to 5 year highs in inventory as we're going into a slower, or typically slower, summer months here. But we also know that real estate, it takes time to move into any new direction. Because, check out this stat, as of May 15th, the average home price in GVRD is sitting at an all-time high. All-time high. You just heard that right. It's $5,000 above the February 2022 peak. But let's not get too excited or too angry, and let's just let the rest of the month play out. But the fact that we've been hitting new price peaks recently is nothing short of shocking, as 5% rates have been here for almost a year. And basically, we're seeing all-time high prices across the country. We've got 6 of 10 provinces that are all-time highs. We've got average price sitting at all-time highs. We've got HPI and condos at all-time highs 2 months ago here. It's just the exact opposite of what I think the vast majority of people, even within the real estate space, expected. It just speaks to the resiliency of this asset that continues to shine above most others. Ryan, any final thoughts?
Yeah, I mean, I think when you consider what you just talked about, how, we're sitting at all-time highs, and it just doesn't seem to correlate with how the rest of the economy is performing. And do remember that the housing cycles typically lead the business cycles. So we're seeing these business cycles really stumbling right now. I mean, we went through basically business delinquencies or closures that are 50 to 100% higher than what they typically are at this time. And so my question is, if we begin to lower interest rates in the coming future here, first of all, I think it'll be slow, but then I think it'll actually pick up pace, because I think the majority of what's taking place in Canada's economy is a lot worse than maybe what we're dealing with right now. I think it's going to get harder for businesses before it gets better. And I think the reaction to that will be that the Bank of Canada, once they begin the rate cutting cycle, will continue to cut rates. And, we could see, not this year, but I think well into 2025, we could see, 150 basis point drop by that time. At which point you're likely to see prices in asset classes go up, likely before the rest of the economy. It's historical, it's cyclical, it seems to happen every time. So pay close attention to that. And I think we also expect some divergence from what's taking place down in the US. The US was sitting on a $2.1 trillion savings and checkings and savings cushion, which elongated that process by what you mentioned, Dan, 12 to 18 months. We can't go another 12 to 18 months at high rates without things cratering, without the economy stalling and us going into a full-blown recession, which honestly would probably help reset things. But that's, speaking economically, not emotionally. So with that said, I think we're going to see some divergence from the US, at least in the short run. And then I think, the information we've been fed so far is likely going to get a little bit worse before it gets better. But pay close attention to the cycles in real estate, because that's where you're going to see the shifts in dynamics take place.
I think lastly here too, all you have to do is look at the housing price chart for GVRD dating back to the 70s. I mean, it's one of the most up and to the right charts you can ever find. And I think a lot of people continue to have faith in such data. Maybe you got screwed in cryptocurrency. Maybe your stock portfolio took a hit, but you keep talking to people about their real estate holdings and they seem to continue to outperform most of the other marketplaces. And then you've got a government who says 9 years ago that they're going to make housing affordable, and then it goes up 150%, right? It's a runaway train in that sense, and love it or hate it, but it just becomes a protected asset that we know the government will, never campaign on lowering prices. Here we are at all-time high prices in most of the country. And are any politicians campaigning on lowering prices? I mean, they're saying making it affordable, but that means making you have essentially more buying power. They're not trying to reduce the prices. So I think, again and again, it keeps coming back to it's sort of the most solid and protected asset in Canada. And as we know, they can't build them fast enough for how fast we're growing and how fast they're needed. So simple supply and dynamics will always continue potentially. You can't always say always, but hypothetically here and based on the information, continue to push this thing up and to the right. Hopefully just not at such an unrealistic pace as we've seen over the last couple decades. Thank you, as always, for tuning in. We look forward to seeing you guys next week.